I'd like us to move into the capital market, where lots of developments have been taking place. I'm going to start off first. How do you think the NPR itself will have any form of impact on the capital market?
There's an inverse relationship between interest rates and asset prices, asset values. So once interest rates increase, asset values, because the alternative to holding assets is cash. And if you invest the cash, you get a return. So the average dividend yield in the stock market today is something like 2 or 3%, while the average return on treasury bills is about 10 or 11%. So people trade off and say, okay, if I'm expecting some capital gains, I'll stay in the stock market and allow that rise. Now, what has happened is that the stock market impact two effects. One, the relationship between interest rates and asset values. The second part is that 50% or 55% of the stock market capitalization of banking stocks, banking profitability is going to erode because of the net interest margin impact of CRR. And therefore, you'll see that in the last 2-3 days, all banks, Tier 1, Tier 2, and Tier 3, have all had their stocks hit, because the stock price is the present value of future earnings. If you project that the future earnings of banks is actually going to come down, then you begin to discount those prices immediately. And that's why you see the market is actually pushing down the price of the banking stock. However, having said that, I don't think what you will see is a correction. There are 3 levels of negative movements in stock markets. The first is a correction, the second is a bear market, and the third is a crash. A correction is anything between 1 and 10%. The market had already gained over 44 or 45% last year. So if you have a correction of, say, 5% or something like that, that's not a big deal. So the market will correct and then begin to go back up after it finds what they call fair value.
Okay, looking at the capital market in general, any impact at all in terms of the portfolio investment? Would there be implications? Because coming from the West, where this development of hiking, or rather the removal of the stimulus package from the U.S. Fed, would this have any form of direct impact?
No, the timing is
on portfolio investment.
The timing is bad, right? Because on one hand, portfolio investors were actually down to about 49% from a high of 70%, which is okay for Nigeria. But you have that tapering, and then on top of that, you have this other impact here. Now, because we pushed up the interest rates, that is a counter to, so that a man who is a European investor sees higher interest rates in Nigeria, and that will kind of actually discourage him from taking the money out of Nigeria. So this is a way of protecting yourself from that reversal of hot money. However, one thing that we must know as a country in managing our external reserves is that you have your own money and you have international investors' money. Your own money is your own revenue. The difference is that international investors' money are what we call liabilities. Liabilities, at one point in time, you are going to have to repay them with interest. So you cannot depend on international liabilities to show up your currency or to show up your economy. It's useful to have it, but you cannot depend on it solely. So in some countries, there are even controls from allowing it to come in. Because when it goes out, it can be destabilizing. We saw what happened in Southeast Asia in 1995 to 97. We saw what happened in Mexico, and we've seen it happen in different places. We cannot be dependent on hot money.
So the key is having to encourage the local investors to be big players in the markets.
Yes, but you see, the point is that you have to move from what we call good to have to need to have. That is, it's good to have international money, right? But you don't want to be in a position where you need to have it. What Nigeria is saying now is that it's been good to have it, and now we are going to a situation where we need to have it. When you need to have it, then you have to do things at all costs to keep it. Okay.
There's a particular issue that actually came up a few weeks ago at the capital market. I just want us to look into it before we move on. We have much time. The SEC's decision on Investor Protection Fund. Could you shed more light on this development for us?
Well, the SEC has been very clear as to what its objectives are. 1, sanitizing the market. 2, zero tolerance for infractions, right? And 3, setting the environment using technology as an enabler, and also to protect investors and grow the collective investor schemes. You know, if you look at our market, you say we have a market of, say, X billion dollars. The total amount of collective investor scheme in this market is maybe $500 million or maybe $1 billion compared to, so it is minuscule. Markets survive and thrive based on the collective investor scheme, the mass participation, not on a few participants in the market. So what has the SEC done? The SEC has said, well, one, they've sanitized the market, gone against infractions of broker dealers. They've set new rules and codified the rules. They have actually set up investor protection schemes. And so once investors are protected, they know that there's integrity in the numbers that are coming out of the market, then people begin to invest for the long run, not short-term speculators. So it is important, and it's good that these things happen. And it is in the interest of the market, the exchange, one, two, the investors, and three, this objective of making Nigeria the most attractive destination of capital can only be fulfilled if all of these things are happening. So I think it's a good thing. SEC has been pretty focused on what they want to achieve, and one can only give them credit for what they have achieved. So
okay, I'd like us to go back to the exchange rate issue. As recently, the central bank removed the restrictions on dollar sales to BDC operators in a bid to bridge the gap between the parallel and the official market. This has been an ongoing issue. It keeps recurring at the moment. But how do you think that can be achieved?
What you see, the market, what we call harmonization of exchange rates and desegmentation of the market. This market has three segments: one, official; two, interbank; and three, parallel. When you see that kind of divergence, it means that there's a distortion to the pricing structure. And the distortion was brought about by this restriction of cash. So on Friday, when they issued this circular, the market moved from 172 all the way to 165 in a matter of 20 minutes. We showed that 172 was a unnatural price. Okay. Having said that, it's going to go down, right? But what you need to do is to complement that with some depreciation in the official rate, so that there's convergence at near the fair value. So what's going to happen is that those who are speculating against the naira are going to lose a lot of money in the next week or two, and then the market stabilizes at the bottom, and then we begin to see the fundamentals. The fundamentals are that as long as there's oil vandalism, as long as there's oil theft, as long as there's fiscal recklessness, both at the state and federal level, the fundamentals that support the currency value will be threatened. Okay, so all of these things have to play together. One, there should be fiscal responsibility, fiscal consolidation. Ngozi Okonjo-Iweala has already mentioned that. And then there should be monetary adjustment at the central bank, all of this to bring about a fair value of the naira. There was no reason for the naira to depreciate to 176. That was a speculative attack on the naira. And by removing this, you will see that the naira comes back to some fair value. But we shouldn't rest on our hands. The point is that the bureau de changes are going to demand more dollars, and that will bring pressure on the official market. Especially
having to meet this demand.
And that's all
we've seen oil firms or international oil companies having to sell dollars in the market just in a way to, as part of ways to actually meet the demand. But wouldn't this reoccur again? Reoccur in the sense that this demand will keep coming, and the central bank will always be under pressure to meet them.
The reality is that once there's excess demand in anything, the only thing to do is to increase the price. When you increase the price of the currency, that means you allow the currency to depreciate. But that's what nobody wants to hear about, right? But that is the reality. That's what we call the inconvenient truth. The inconvenient truth is that if there's demand for currency, and if the currency is being used for what? For consumption, not for investment. We are bringing petrol, kerosene, all sorts of things into the country. So it's consumption driven. But, that's the reality. Those adjustments, those difficult adjustments are not going to happen in an election year. Nobody's going to do that.
Now, still talking about the election year where the fiscal policy is actually linked to. It seems that not much seems to be happening on the fiscal side. We're having a lot of decisions from the monetary policy stand, but the fiscal side, not much is taking place. The budget is not been passed yet, and the budget, some kind of debate around it.
The budget will always be a hostage to politicians in the National Assembly, but that's the price of democracy. The Minister of Finance went on at length to discuss about the budget and all the strengths and all that. budget of consolidation, budget of growth, budget of job inclusion, and all of that. So after the names and all of that, let's go down to the reality. The reality is that a budget has to be passed. And if that budget is not passed, right? But the most important thing about that budget is that aggregate expenditure actually came down, good. But within the budget, 73% is recurrent, which means they're going to be spending on debt service, on ESTA code, and all sorts of things, on consumption again. Well, there is need for capital formation, but it's not going to happen again in 2014. All of these things will happen. The Nigerian macroeconomic story is intact, right? It's intact from 2015 onwards. But from 2014 to 2015, all you are going to have is politics, politics, politics.
Okay, so do you think that central bank can really achieve much without a complementary fiscal policy?
Well, the central bank
Can it operate on its own without having to move along what the government is trying to do?
There are three types of organizations within the public space. One are policymakers, right, where the central bank makes some policies. Two are regulators, where you regulate. That is where the Securities and Exchange Commission and the central bank again regulates the financial system. And third are stabilizers. The stabilizing institutions are AMCON and others to ensure that you detoxify the risk asset environment. All of those three work together. But what happened, the reality is that in an election year, those three levels are going to be much more sedate than they are in a normal time. But immediately after elections, we have a country to run. And all of them will come back from what they're doing. What they're doing now is just kind of mothballing what they're doing to achieve the desired objectives.
So, finally, just before I let you go, how long do you think this tightening will continue?
My personal projection is that it will tighten. There will be one more meeting in March.
Before Sanusi leaves office.
Sanusi leaves in June. So you can even have an extraordinary meeting. When we increased the MPR to 12%, it was under an extraordinary regime. We just called the meeting, So all of these things will happen. So I think that until Sanusi leaves, you have a tightening, but after that, you probably have a easing up of monetary policy. In any case, by June, will be full election cycle. So the politics of transition at the central bank will be followed by the politics of the
transition
election
at the government,
at
the center.
Yes.
Thank you, Bismarck Orani. We do appreciate your time with us. I have to let you go at this point. Bismarck Orani is the CEO of Financial Derivatives Company Limited, and he has been talking about the Nigerian economy, what needs to be done to ensure that we maintain the level of growth that we all look for to be able to achieve our goals and objectives by the end of the year. More so, we're going into an election year, and it's a very serious issue. Apart from the fact that the monetary policy is trying to contain the excess liquidity in the economy, the fiscal side has been heating up because of the election, and of course the budget that is yet to be passed. So keep our eyes on these developments as we get more information and get you posted as well on them. And that's where we'll draw the curtain on today's edition of Business Morning. We do appreciate your time with us. In the meantime, you can log on to channelstv.com for more information in this program. And of course, send us your comments and emails. Thank you for watching. I am Bolaji Akimali. News Track is coming up next.